In our earlier discussion of the LIFO retail method, we assumed that the retail prices of the inventory remained stable during the period. If you recall, we compared the ending inventory at retail with the beginning inventory at retail to see if inventory had in fact increased. If the dollar amount of ending inventory exceeded the beginning amount, we assumed a new LIFO layer had been added. But this isn't necessarily true. It may be that the dollar amount of ending inventory exceeded the beginning amount simply because prices increased without an actual change in the quantity of goods. So to see if there's been a real increase in quantity, we need a way to eliminate the effect of any price changes before we compare the ending inventory with the beginning inventory. Fortunately, we can accomplish this by combining two methods we've already talked about, the LIFO retail method and the dollar value LIFO. The combination is called the dollar value LIFO retail method. To illustrate, we return to the home improvement store situation in which we applied LIFO retail. We keep the same inventory data but change the illustration from the month of July to the fiscal year 2018. This allows us to build into this illustration a significant change in retail prices over the year of a 10%, an increase in the retail price index from 1 to 1.10. We followed the LIFO retail procedure up to the point of comparing the ending inventory with the beginning inventory. Because prices have risen, the apparent increase in inventory is only partly due to an additional layer of inventory and partly due to the increase in retail prices. The real increase is found by deflating the ending inventory amount to beginning of the year prices before comparing beginning and ending amounts. We did this with the dollar value LIFO technique. So in this slide, the ending inventory at retail of $198,000 is restated to base year prices of $180,000. By comparing this restated amount to the beginning inventory layer of $160,000, it reveals that a layer of $20,000 has been added in 2018. Multiplying each layer by its retail price index and by its cost to retail percentage converts it from retail to cost. The two layers are added to derive ending inventory at dollar value LIFO retail cost. When additional layers are added in subsequent years, their LIFO amounts are determined the same way. So when additional layers are added in the subsequent years, their LIFO amounts are determined the same way. For example, let's assume ending inventory in 2019 is $226,200 at current retail prices, and the price level has risen to 1.16. Also assume that the cost to retail percentage for 2019 net purchases is 63%. Here the ending inventory is converted to base year retail prices in step 1. The amount is apportioned into layers, each at base year retail prices, step 2. Layers are then converted to LIFO costs in step 3. Now, let's assume that ending inventory in 2019 is $204,160 at current retail prices instead of $226,200, as in the previous example, and the price level has risen to 1.16. Also assume that the cost to retail percentages for 2019 net purchases is 63%. Step 1 converts the ending inventory to a base year price of $176,000, which is $204,160 divided by 1.16. Recall from the prior example that ending inventory in 2018 at base year prices was $180,000. The decrease in ending inventory is $176,000 at base year prices, indicates that inventory decreased during 2019. In this scenario, no 2019 layers added, and the 2019 ending inventory is dollar value LIFO retail of $110,584 as determined here. A portion of the 2018 inventory layer has been liquidated, reduced from $20,000 to $16,000 at base year prices, to reduce total inventory at base year prices to $176,000. So let's take a look at this concept question. On January 1st of 2018, the Bowden Corporation adopted the dollar value LIFO retail inventory method. Below is information related to inventory. So we see our beginning inventory at cost of $60,000, retail of $94,000, purchases during the year, cost $2,015, retail $310,000, and then annual net sales of $300,000. The retail price index at the end of 2018 was 1.04. Ending inventory at dollar value LIFO cost is A, $65,000, B, $67,600, C, $64,056, or D, $100,000. So basically, the way we calculate the answer, we begin with $60,000 of beginning inventory at cost, divide that by our retail to come up with 63.83% cost to retail. In 2018, we added $201,500 in purchases, divide that by $310,000 retail, which gives us 65%. The ending inventory at year-end retail prices is the 94 plus the 310 minus our sales equals 104,000 retail value. The ending inventory at base year retail prices would be the 104,000 divided by 1.04 to give us 100,000. Layers converted to LIFO cost, we begin 94,000 times 1 times the 0.6383 is 60,000, and then in 2018 our 6,000 times 1.04 at 65% gives us $4,056. Totals 100,000, and our total value $64,056 at dollar cost LIFO. Now let's look at exercise 9.19. On January 1st, year 1, the Willowback Company adopted the dollar value LIFO retail method. The following data are available for year 1. Again, we have our beginning inventory, cost of $77,140, retail of $133,000, our net purchases at cost $111,760, net purchases at retail $259, markups $6,000, markdowns $11,000, net sales $235,639, and our retail price index December 31st of year 1, 1.04. We're going to calculate the estimated ending inventory and cost of goods sold for year 1. So as you see here, we are going to come up with the base year cost at retail. 77 divided by 133 gives us 58% cost to retail. Then our purchases during year 1, the 111, divided by 254 gives us 44%. So we've got our beginning inventory, $77,140. Retail's $133. Our purchases, $111. Retail, $259. Our markups and our markdowns. Goods available, $387. Our net sales are $235, $639. Our ending inventory, $151, $361. So, ending inventory at year-end retail sales, divide that by our ending inventory at base year retail prices, gives us $154, $539. We've got the inventory layers, which will basically be the 133 times our factor of 1 equals the 133,000 times 58%, or 77,140. And then the layer 12,539 times 1.04 index gives us 13,041 times 44%, 5738, for a total of $82,878. Accounting principles should be applied consistently from one period to the next period to allow for comparability of operating results. However, changes within a company as well as changes in the external economic environment may require a company to change an accounting method. In the past, high inflation periods motivated many companies to switch to LIFO for the tax benefit. Usually there are two types of inventory method changes. Most inventory method changes and changes to the LIFO method. Most voluntary changes in accounting principles are reported retrospectively. This means reporting all previous periods' financial statements as if the new method had been used in all prior periods. Changes in inventory methods other than a change to LIFO are treated that way. The first step is to revise prior year's financial statements. For each year reported in the comparative statements, the company makes those statements appear as if the newly adopted inventory method had been adopted or applied all along. In the second step, a journal entry is recorded to adjust the book balances from their current amounts to what those balances would have been using the newly adopted inventory method. Because differences in the cost of goods sold and the income are reflected in retained earnings, as are the income tax effects, the journal entry updates inventory, retained earnings, and the appropriate income tax account. In the third step, the company must provide in a disclosure note clear justification that the change to the newly adopted inventory method is preferable. When a company changes to the LIFO inventory method from any other method, it usually is impossible to calculate the income effect on prior years. To do so would require assumptions as to when specific LIFO inventory layers were created in years prior to the change. As a result, a company changing to LIFO usually does not report the change retrospectively. Instead, the LIFO method simply is used from that point on. The base year inventory for all future LIFO determinations is the beginning inventory in the year the LIFO method is adopted. A disclosure note is needed to explain the nature of and justification for the change, the effect of the change on the current year's income and earnings per share, and why retrospective application was impractical. Let's discuss the steps involved in a change in inventory method with an illustration. The first step is to revise prior year's financial statements. This is for each year reported in the comparative statements. AutoGeek makes those statements appear as if the newly adopted inventory method, FIFO, has been applied all along. In its balance sheets, assuming that the company presents financial balance sheets for 2 years for comparative purposes, the company would report 2018 inventory by its newly adopted method, FIFO, and also would revise the amounts it reported last year for its 2017 inventory. In its 2018 and prior year income statements, cost of goods sold would also reflect the new method. In its statement of shareholders' equity, AutoGeek would report retained earnings each year as if it had used FIFO all along. And for the earliest year reported, the company would revise beginning retained earnings that year to reflect the cumulative income effect of the difference in inventory methods for all prior years. AutoGeek also would record a journal entry to adjust the book balances from their current amounts to what those balances would have been using FIFO. Because differences in cost of goods sold and income are reflected in retained earnings, as are the income tax effects, the journal entry updates inventory, retained earnings, and the appropriate income tax account. The journal entry seen here, ignoring income taxes, increases the 2018 beginning inventory to the FIFO basis amount of $146,000 and increases retained earnings by the same amount, because that's what the increase in prior year's income would have been had FIFO been used. Here we see an example of such a disclosure note in a recent annual report of CVS Health Corporation when it changed its inventory method for retail LTC inventories to the averaged cost method. When a company changes to the LIFO inventory method from any other method, it usually is impossible to calculate the income effect on prior years. To do so would require assumptions as to when specific LIFO inventory layers were created in years prior to the change. As a result, a company changing to LIFO usually does not report the change retrospectively. The LIFO method simply is used from that point on. The base year inventory for all future LIFO determinations is the beginning inventory in the year the LIFO method is adopted. A disclosure note is needed to explain the nature of and justification for the change, the effect of the change on current year's income and earnings per share, and why retrospective application is impractical. When Seneca Foods Corporation adopted the LIFO inventory method, it reported the change in the notes shown here. In the second paragraph of the disclosure, the company states why retrospective application was impractical. Here the reason is the company's inability to obtain period-specific information necessary to analyze inventories and to determine when specific LIFO inventory layers were created in fiscal years prior to the change. In the third paragraph of the disclosure, the company explains the effect of the change on current and prior fiscal years' income and earnings per share. Notice in the Seneca Foods disclosure note that the switch to LIFO did cause a decrease in net income, and therefore income taxes in the year of the switch, indicating an environment of increasing costs. Let's take a look at the next concept question. In 2018, the Beldry Company switched its inventory method from average cost to FIFO. Inventories at the end of 2017 were reported in the balance sheet at $55 million. If the FIFO method had been used, 2017 ending inventory would have been $50 million. Ignoring the effect of income taxes, the adjustment to 2018's beginning retained earnings would be A, 0, B, a $50 million increase, C, a $5 million increase, or D, a $5 million decrease. So as you see here, 2017 cost of goods sold would have been higher by $5 million, reducing income and retained earnings by $5 million. Now let's look at exercise 924. Simpson Company had used the FIFO method of inventory valuation since it began operations in year 1. Simpson decided to change to the average cost method for determining inventory costs at the beginning of year 2. The following schedule shows year-end inventory balances under the FIFO and average cost methods. Ignoring income taxes, prepare the year 4 journal entry to adjust the accounts to reflect the average cost method. Number 2, how much higher or lower would cost of goods sold be in the year 3 revised income statement? So as you see, the journal entry in year 4 would be a debit to retained earnings for $400 and a credit to inventory for $400. Average cost $5,600, FIFO $6,000. So by changing it from FIFO to average cost, we would reduce our inventory and debit the retained earnings. How much higher or lower would cost of goods sold be in the year 3 revised income statement? Well, the decrease in beginning inventory is $1,620. The decrease in ending inventory is $400. So the net decrease in cost of goods sold would be $1,220. Inventory errors include the over or understatement of ending inventory due to a mistake in physical count or a mistake in pricing inventory quantities. These errors may also occur by not recording purchases at the proper time. If an inventory error is discovered in the same accounting period it occurred, the original erroneous entry should simply be reversed and the appropriate entry recorded. This situation presents no particular reporting problems, but if a material inventory error is discovered in an accounting period subsequent to the period in which the error was made, any previous year's financial statements that were incorrect as a result of the error are retrospectively restated to reflect the correction. Of course, any account balances that are incurred as a result of the error are corrected by journal entry. If due to an error affecting net income, retained earnings is one of the incorrect amounts, then the correction is reported as a prior period adjustment to the beginning balance on the statement of shareholders' equity. Also, a disclosure note is needed to describe the nature of the error and the impact of its correction on net income, each line item affected, and the earnings per share. When analyzing inventory errors, it's helpful to visualize the way cost of goods sold, net income, and retained earnings are determined. Beginning inventory and net purchases are added in the calculation of cost of goods sold. If either of these is overstated or understated, then cost of goods sold would be overstated or understated. On the other hand, ending inventory is deducted in the calculation of cost of goods sold. So if ending inventory is overstated, then cost of goods sold is understated. Of course, errors that affect income also will affect income taxes. In this slide here, we ignore the tax effects on the errors and focus on the errors themselves rather than the tax aspects. In this slide, ending inventory is overstated by $800,000, which causes cost of goods sold to be understated and net income and retained earnings to be overstated. Here we see how the error impacted 2017 and 2018. First, let's assume the error is discovered in 2018. The 2017 financial statements that were incorrect as a result of the error are retrospectively restated to reflect the correct inventory amount, cost of goods sold, net income, and retained earnings when those statements are reported again for comparative purposes in the 2018 annual report. The journal entry seen here, ignoring income taxes, corrects the error. Because retained earnings is one of the accounts that is incorrect, when the error is discovered in 2018, the correction to that account is reported as a prior period adjustment to the 2018 beginning retained earnings balance in Barton's statement of shareholders' equity. Prior period adjustments do not flow through the income statement, but directly adjust retained earnings. If the error in 2017 isn't discovered until 2019, the 2018 financial statements also are retrospectively restated to reflect the correct cost of goods sold and net income, even though no correcting entry would be needed at that point. Inventory and retained earnings would not require adjustment. The error has self-corrected and no prior period adjustment is needed. Also, a disclosure note in Barton's annual report should describe the nature of the error and the impact of its correction on each year's net income, overstated by $800,000 in 2017 and understated by $800,000 in 2018, the line items affected, and the earnings per share. So here's another question for you. Hightower Company uses a periodic inventory system. Beginning inventory on January 1st of 2018 was overstated by $49,000, and ending inventory on December 31st, 2018 was understated by $79,000. These errors were not discovered until 2019. As a result, Hightower's cost of goods sold for 2018 was A. Understated by $128,000, B. Overstated by $128,000, C. Overstated by $30,000, or D. Understated by $30,000. So as you see, $49,000 plus the $79,000 is the $128,000 overstatement of cost of goods sold. Let's take a look at exercise 928. In year 2, the controller of Delta Corporation discovered that $42,800 of inventory purchases were incorrectly charged to advertising expense in year 1. In addition, the year 1 year-end inventory count failed to include $31,700 of company merchandise held on consignments by Aaron Brothers. Delta uses a periodic inventory system. Other than the omission of the merchandise on consignment, the year-end inventory count was correct. The amounts of the errors are deemed to be material. Determine the effect of the errors on retained earnings in January 1st of year 2. So as we see here, the 42,800 inventory purchases were shown to be included in advertising expense in year 1. So the cost of goods sold in this year was understated by $42,000, and our advertising expense was overstated by $42,800. The $31,700 error on the consignment showed a reduction in assets by $31,700, which understated inventory, but it also reduced our net income because it overstated our cost of goods sold. The journal entry to correct the errors would be a debit to inventory for $31,700 and a credit to retained earnings of $31,700 to correct beginning inventory balance. Purchase commitments are contracts that obligate a company to purchase a specific amount of merchandise or raw materials at specified prices on or before specified dates. Companies enter into these agreements to make sure they'll be able to obtain inventory as well as to protect against increases in purchase prices. However, if the purchase price decreases before the agreement's exercised, then the commitment has the disadvantage of requiring the company to purchase inventory at a higher than market price. If this happens, a loss on the purchase commitment is recorded. Because purchase commitments create the possibility of this kind of loss, the loss occurs when the market price falls below the commitment price, rather than when the inventory eventually is sold. This means recording the loss when the product is purchased, or if the commitment is still outstanding at the end of the reporting period. In other words, purchases are recorded at market price when that price is lower than the contract price, and a loss is recognized for the difference. Also, losses are recognized for any purchase commitments outstanding at the end of a reporting period when market price is less than contract price. So, let's study purchase commitments with an illustration. In July of 2018, the Lassiter Company signed two purchase commitments. The first requires Lassiter to purchase inventory for $500,000 by November 15th of 2018. The second requires Lassiter to purchase inventory for $600,000 by February 15th, 2019. Lassiter's fiscal year end is December 31st. The company uses a perpetual inventory system. The contract period for the first commitment is contained within the single fiscal year. Lassiter would record the purchase at the contract price if the market price of inventory at date of acquisition is equal to or greater than the contract price of $500,000. But if the market price of inventory at acquisition is less than the contract price, inventory is recorded at the market price and a loss is recognized. So for example, if the market price is $425,000 at the time of acquisition, Lassiter still has to pay $500,000, the contract price, and the inventory is recorded at the market price of $425,000. The difference of $75,000, $500,000 of cash paid less the $425,000 market price, is recorded as a loss on the purchase commitment. The objective of this treatment is to associate the loss with the period in which the price declines, rather than with the period in which the company eventually sells the inventory. Now let's consider Lassiter's second purchase commitment that's outstanding at the end of the fiscal year 2018. The purchases have not yet been made. If the market price of inventory at the end of the year is equal to or greater than the contract price of $600,000, no entry needs to be recorded. However, if the market price at year end is less than the contract price, a loss must be recognized. The objective is to associate the loss with the period in which the price declines, rather than the period in which the company eventually sells the inventory. Let's say the year-end market price of the inventory for Lassiter's second purchase commitment is $540,000. The entry shown here is recorded. Now at this point, the loss is an estimated loss. The actual loss, if any, will not be known until the inventory actually is purchased. The best estimate of the market price on date of purchase is the current market price. In this case, $540,000. Because no inventory has been acquired, we can't credit inventory for the loss. Instead, a liability is credited because, in a sense, the loss represents an obligation to purchase inventory above market value. So the entry to record the actual purchase on or before February 15th, 2019 will vary depending on the market price of the inventory at date of purchase. If the market price is unchanged or has increased from the year-end price, the entry shown here will be made. Even if the market price of the inventory increases, there's no recovery of the $60,000 loss recognized in 2018. Similar to the method of recording inventory at the lower of cost or market, the reduced inventory value in this case, the reduced value of purchases is considered to be the new cost, and any recovery of value is ignored. Now, if the market price declines even further from year-end levels, an additional loss is recognized. So if the market price of the inventory covered by the commitment declines to $510,000, the entry shown here gets recorded. Again, the total loss on this purchase commitment of $90,000 is thus allocated between 2018 and 2019 according to when the decline in value of the inventory covered by the commitment occurred. If there are material amounts of purchase commitments outstanding at the end of a reporting period, the contract details are disclosed in a note. This disclosure is required even if no loss estimate has been recorded. So on August 15th of 2018, Pesky Corporation signed a purchase commitment to purchase inventory for $300,000 on or before February 20th of 2019. Pesky's fiscal year end is December 31st. The contract was exercised on February 3rd, 2019, and the inventory was purchased for cash at the contract price. On the purchase date of February 3rd, the market price of the inventory was $315,000. The market price of the inventory on December 31st, 2018 was $270,000. The company uses a perpetual inventory system. So how much loss on purchase commitment will Pesky recognize in 2018? $45,000, $30,000, $15,000, or none? So the correct answer would be the $30,000 loss. We would take the $300,000 commitment minus the $270,000 market price of the inventory on December 31st, 2018. Now let's look at exercise 930. On October 6th of year 1, the Unified Corporation signed a purchase commitment to purchase inventory for $61,000 on or before March 31st, year 2. The company's fiscal year end is December 31st. The contract was exercised on March 21st, year 2, and the inventory was purchased for cash at the contract price. On the purchase date of March 21st, the market price of the inventory was $54,900. The market price of the inventory on December 31st, year 1, was $56,933. The company uses a perpetual inventory system. Prepare the necessary adjusting entry, if any is required, on December 31st of year 1. So basically, we're going to have to record an estimated loss on purchase commitment. Now, the estimated loss on the purchase commitment, a debit of $4,067, and then we're going to credit a liability. So basically, what will happen is we were going to purchase the items for $61,000, but the inventory had a market price of $54,900. The market price on the inventory on December 31st was $56,933. So the difference between the $61,000 and then what the market price was on December 31st shows the difference of the $4,067. Next, in year 2, when we purchase the goods, we will show inventory of $54,900. We will debit our liability for $4,067. We will debit our loss on the purchase commitment for $2,033 and credit our cash for $61,000, which was the purchase commitment. Well, there you have it. This has been a tough chapter. There's a lot to cover here, and it can get confusing, so I just recommend you review it over and over again.